The Center for Promotion of Private Enterprises has released its commentary on Nigeria's July 2025 inflation report, describing the latest figure as a mixed bag of progress and persistent vulnerability. While headline and core inflation shows signs of easing, food price and monthly inflation trends continue to pose challenges for policymakers. Welcome to Business Point, where we extract the Nigerian economy and the government's policies. I am Kike Lomo Okeri. According to the National Bureau of Statistics, headline inflation declined for the fourth consecutive month, falling from 22.22% in June to 21.88% in July, a 0.34% deceleration. Month-on-month food inflation also moderated slightly, easing from 3.25% to 3.12%. Core inflation posted a marginal year-on-year decline of 0.03%, while month-on-month core inflation dropped sharply from 3.46% to 0.97%. Dr. Muda Yusuf, Director CEO of CPPE, attributed the improvement to a stabilizing macroeconomic environment supported by relative exchange rate calm, improved investor sentiment, and the impact of import duty waivers on essential staples such as rice, maize, and sorghum. He also noted that the base effect stemming from elevated inflation levels in 2022 has contributed to the downward trend. However, Yusuf cautioned against premature celebration. Month-on-month headline inflation rose from 1.68% in June to 1.99% in July, while year-on-year food inflation increased from 21.97% to 22.74%. These figures, he says, reflect the economy's continued exposure to supply-side shock and structural inefficiency. To consolidate recent gains and address lingering inflationary pressure, CPPE outlined several key policies, priorities: foreign exchange stability, that is, sustaining calm in the FX market to anchor inflation expectation, tackling high logistic cost insecurity, climate-related disruption, and port inefficiency, ensuring prudent government spending and managing liquidity injection to avoid stocking inflation, exploring creative liquidity management tools beyond conventional tightening measures, especially as a lending rate which has surged above 30% for many businesses. The July inflation report offers a basis for caution optimism. Yusuf stated that while headline and core inflation have moderated, the persistence of food price pressures and monthly inflation spikes underscores the need for coordinated monetary, fiscal, and structural reform. The latest NBS report shows that Nigeria's urban inflation rate stood at 22.01% in July 2025, which was 13.76 percentage points lower compared to 35.77% recorded in July 2024. On a month-on-month basis, the urban inflation rate was 1.86% in July 2025, down by 0.25% compared to June 2025, which was at 2.11%. The corresponding 12-month average for the urban inflation rate was 27.04% in July 2025. This was 5.85 percentage points lower compared to 32.89% reported in July 2024. On the other hand, the rural inflation rate in July 2025 was 21.08% on a year-on-year basis. This was 10.17 percentage points lower compared to 31.26% recorded in July 2024. On a month-on-month basis, the rural inflation in July 2025 was 2.30%, up by 1.67% compared to June 2025, which was 0.63%. The corresponding 12-month average for the rural inflationary in July 2025 was 23.84%. This was 5.02 percent points lower compared to 28.86% recorded in July 2024. Nigeria has emerged as the leader in economic expansion and employment opportunity in Singapore's deepening trade relationship with West Africa, which has seen an 85% rise to $7.47 billion from 2020 to 2024. A review of the growing collaboration between Singapore and West Africa shows Nigeria emerging as a key contributor. Analysis of the data from the United Nations Trade and Development reveals that as at the end of 2023, Singapore's overall economic presence in Africa comprises more than $20 billion in foreign direct investment, and Nigeria currently stands as one of the leading 10 investment economies in Africa. Additionally, the Asian nations' involvement in Nigeria's presence, an approach that contrasts significantly with conventional foreign investment methods in the region. Besides just trading goods, Singaporean companies emphasize generating local value and promoting sustainable development. Enterprise Singapore has greatly assisted Singaporean firms like Tolaram Group and Velancy in their operations within the Lagos Free Trade Zone. This firm has set up a local factories and processing facility, especially in Nigerian agri-commodity sector, a decision that enhanced local industrial capability while promoting jobs and domestic economic strength. In contrast to traditional investors who typically extract resources from overseas processing, Singaporean-backed initiatives are establishing a foundation for inclusive development by ensuring a larger portion of the production value chain stay within Nigeria. This approach aims to create sustainable jobs, cultivate local skill sets, and enhance domestic markets. From 2020 to 2024, the exchange of goods between Singapore and Nigeria saw significant variation. It started at $727.2 million in 2020, increased notably to $277.3 million in 2021, and then fell to $712.1 million in 2022. The decrease persists in 2023, with the trade dropping to $410.8 million, but bounced back in 2024 to attain $679.1 million. These numbers indicate the changing character of trade relationship and developing investment environment between the two nations, even with variation in trade volume. Singapore's dedication to Nigerian markets, especially in the area that promotes sustainable development, indicates a long-term strategic outlook. Industry experts indicate that Nigeria's pivotal position in West Africa economy renders it a desirable collaborator for investment strategies aimed at growth. Singapore's strategy in Nigeria could establish a standard for how global collaboration can address the host nation developmental need while maintaining profitability. Nigeria's manufacturing sector is turning inward for survival as the impact of the naira devaluation and foreign exchange scarcity continues to reshape supply chain across the country. This is according to a new report which highlighted how volatility in the forex market is forcing companies to reduce their dollar reliance and turn to local raw material sourcing. According to the report, firms that previously depended on raw material imports are increasingly embracing local supply chain to ease pressure on foreign exchange. This decision followed the Central Bank of Nigeria's decision to float the naira part of President Bola Ahmed Tinubu's reform agenda aimed at reviving growth and attracting investors, which triggered unprecedented volatility. Manufacturers, who contribute about 9% of Nigeria's GDP, were left scrambling as the naira tumbled and dollar inflow dried up. It sparked turbulence across industries, leaving many manufacturers unable to source raw materials from abroad. The Manufacturers Association of Nigeria says about 800 companies shut down operation last year as a result of soaring input costs and shrink access to dollars. Multinationals, including Procter and Gamble, Unilever, GlaxoSmithKline, PZ, Bayer, and Sanofi, have also scaled back operation in recent years, citing Nigerian macroeconomic challenges. The reform have been both destructive and transformative. At Chemical and Allied Products, a leading paint producer executive says the crisis was a wake-up call. Facing ever-rising input costs and the threat of stock shortages, some companies used last year's shock as a catalyst to reduce their reliance on import material. CAP now work with the 3 local vendors to source calcium carbonated, a chemical compound used in paint manufacturing, to provide bulkiness and improve opacity. About 90% of the compound calcium it needs is procured locally. Previously, it relied on import from South Africa, Egypt, Tunisia, and elsewhere. The company estimates it has saved nearly 60% in calcium carbonated cost in the 10 months of June 2025. At the backdrop of rising cost of doing business, Nigerian insurance firms are recording significant decline in profits. Financial finding reveals that the insurance firms are now battered by rising claims payments. Consequently, aggregate profits recorded by the leading insurer dropped by 40% in the first quarter of 2025. The plunge in the profitability, which was in spite of 38% jump in revenue, was in sharp contrast to the 550% rise in profit enjoyed by the insurer in the corresponding period of 2024. Breakdown of the data from 2025 first quarter results of the leading 14 insurance companies shows that gross premium written went up by 38.2% to 294.5 billion naira from 213.1 billion naira recorded in the corresponding period of 2024. Meanwhile, claiming payment went up by 56.6% to 167.4 billion naira in the first quarter of 2025 from 106.9 billion naira recorded in 2024. ICO insurance claim payment rose by 11.8% to 19.9 billion naira from 17.8 billion naira. Mutual benefit profit increased by 13.9% to 4.1 billion naira from 3.6 billion naira. Name profits rose by 21.9% to 12.8 billion naira from 10.5 billion naira. The National Insurance Commission, NICOM, in its first quarter 2025 report, stated that its focused regulatory measures aimed at market deepening has led to enhanced public awareness regarding policyholders' rights and opportunities for claims issue redress, thereby leading to expansion in the rates of claims reported during the quarter under review. NICOM maintained that other explanatory factors are improved customers' confidence and the business expansion recorded in the market, which goes with the increased claim reporting by policyholders. All right, let's take a quick short break. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point on Global Television, where we extract the Nigerian economy and the government policies. The Biden constraint bedeviling Nigeria's manufacturing sector seems to have dampened foreign exchange investors' interest as the foreign direct investment in the sector declined by 32.3% to $129.92 million in the first quarter of 2025, compared to $191.92 million recorded in corresponding period of 2024. The first quarter of 2025 manufacturing FDI figure represents a mere 2.3% of the total capital importation in the period under review. Total capital importation in the first quarter of 2025 amounted to $5.64 billion, indicating a significant 67.12% increase compared to $3.38 billion in the first quarter of 2024, and an increase of 10.86% compared to $5.09 billion in the fourth quarter of 2024. Analysis of the NBS data revealed a year-on-year declining trend in manufacturing FDI over the past 3 years. For instance, the country's manufacturing sector attracted $129.92 million foreign investment in the first quarter of 2025, a decrease of 32.3% compared to $191.92 million recorded in the first quarter of 2024, while the first quarter of 2024 figures is 25.1% less than $256.12 million recorded in the first quarter of 2023. On a quarter-on-quarter basis, the sector's FDI figures in the first quarter of 2025 is even worse compared to the immediate previous quarter, which stood at $421.04 million, indicating a dip of 69%. Analysts attribute the poor performance of the real sector to persistent structural challenges, including adequate power supply, high energy costs, foreign exchange shortage, and policy uncertainty, among others. Further analysis of the NBS data indicates foreign investors' increasing appetite for the quick return financial instrument over long-term manufacturing commitment. The investment pattern is an apparent reflection of the disconnect with Nigeria's industrialization ambition. The NBS first quarter of 2025 capital importation report stated that portfolio investment ranked top with $5.20 billion, accounting for 92.25%, followed by other investments with $311.17 million, accounting for 5.52%. Foreign direct investment recorded the least with $126.29 million, that is 2.24%. On sectoral basis, the banking sector recorded the highest inflow with $3.13 billion, representing 55.44% of total capital imported, followed by the financing sector, valued at $2.11 billion, that is 37.18%, and a production and manufacturing sector with $129.92 million, that is 2.30%. Commenting on the development, Chief Executive Officer of the Center for Promotion of Private Enterprises, Dr. Muda Yusuf, says generally what happened to the manufacturing sector in the last 1 to 3 years are essentially manifestation of the shock of the economic reform. The sector is one of the sectors that were severely impacted negatively We sincerely apologize for the break in transmission. It was due to technical issue. All right, moving on. Currency traders have linked the recent depreciation of Naira at the parallel markets to the supply challenges in the foreign exchange market and the huge demand for the forex as a result of payment to contractors by the federal government agencies. They also cited diversion of forex, especially from diaspora's remittance, as one of the major causes of distortion in the foreign exchange markets. This is coming after the strong performance of the Naira in the month of July, with the local currency trading at 1,530 Naira to a dollar at some point at the parallel market, as against 1,580 Naira to a dollar. It started the month with that was then attributed to the excess supply of forex, the effectiveness of the Central Bank of Nigeria in implementing its policies enhanced fiscal buffer, investors' confidence, a favorable balance of payment position, higher foreign inflow, positive market sentiment, and others. The earlier uptick in the Naira value indicates a positive market response to CBN's ongoing reform and monetary tightening measures. Limited access to foreign exchange has been one of the biggest challenges facing the Nigerian economy. This constraint often forced businesses and travelers to rely on the parallel market for the foreign exchange needs, creating arbitrage opportunities that fueled speculation and further destabilized the system. In reaction to this, the CBN introduced a series of reforms to attract foreign capital, stabilize prices, and restore confidence in the exchange rates regime. However, the Naira appears to have reserved some of the gains recorded last month, as it has in the recent time depreciated against US at the parallel market, although it improved at the official market with minor fluctuation. The Naira closed at 1,560 Naira to a dollar on Friday, August 15, 2025 at the parallel market, as against 1,540 Naira to a dollar. It traded in July 31st, 2025. All right, this is why we call it a wrap on Business Point today. Join me again tomorrow on Global Television Channel 365 and Start Time 276. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.